Hey everybody, Greg Barron here, the professor of real estate. Today you're going to want to stick around because I'm going to show you how the rich get wealthier using a great tax strategy, a great income strategy called cash out refinance. Stay tuned. Hey everybody, Greg Barron here. Thanks for joining us again on my YouTube channel, The Professor of Real Estate. And if I look like I've been up for 5 days, I have. Just got off the airplane this morning at 7 o'clock, took a 5 o'clock flight. I've been to Dallas, Atlanta, Columbus, Cincinnati, and getting ready to head to Austin in a couple of hours. So I am spent, but I'm here for you because we're going to talk about increasing your own personal wealth. So just to be clear, I'm not one of those get-rich-quick guys. I have plowed some hard ground, and these last couple of weeks is indicative of the fact that I have to continue to plow hard ground. But you know what? Real estate, like anything else, is work. Don't let anybody fool you. When you want to get into it, it's going to take a lot of time and energy. Last few weeks, I've been on top of roofs. I've been inspecting interiors of buildings. I've been doing it all. Just like anything else in life, you're going to be dredging it out, having your worst days and thinking it's never going to end. Some days you're going to be totally victorious, and every deal that you touch is going to be a home run. But most of the time, you're just going to have to slug it out. That's the way the real estate business is. It's just grinding it out day after day, year after year. And then one day when you get old like me, you look back and you go, wow, that was really fun. I hope you experience the same thing. Today, I'm going to give you 4 reasons that you need to look at a concept for a great income producing, a great wealth producing scenario. It's called cash out refinance. So I've been able to look at a lot of really successful people in the real estate space over my 37 years in the business, and I can tell you all of them have a system that they stick by that works for them. I want to remind you too that you need to have a system that is specific to your personality. You need to predetermine what it is you want for a cash on cash return, what kind of asset class you really want to get excellent in, what kind of internal rate of return you want to have going out, and you need to have some kind of definitive exit strategy at all times in your hip pocket so that you will stay on course as you're looking at a lot of deals over your lifetime. So let me tone it down just a little bit since I am caffeine energized right now, as you could probably tell. I want to set this project up that will give you an idea of how a cash out refinance will help you retain wealth and leverage the equity that you have for future projects. So I'm going to pop into Performa Plus for a minute and spend just a little bit of time showing you those things that you need to center upon prior to even looking at a cash out refinance. But this is going to be really helpful. So luckily we have a software that we can jump into to show you certain elements that I think if you'll look at this, and maybe you're going to want to replay it to look at it some more, but we're going to go down it sequentially real quick to set the project up before we describe how a cash out refinance will help you to build wealth. Don't want to do that. All right, it is recording. So let me set this up. Are we ready? Am I doing this one? So let me set this up really quick. And I'm going to stay at 30,000 foot so as not to get bogged down in the details, but I think you'll be able to capture the essence of what we're trying to describe. We've got this small project, small relative to some people, big relative to others, but we've got a project. How about that? And it's a medical project. It's located next to a hospital, so it's got a great demographic profile, some existing tenants, and we're going to go in and purchase, keep some tenants in, remodel, value add, and then hopefully either exit or cash out refi. In this case, I'm going to talk about cash out refi. So if you look here, we've got a So if you look here, we've got a total acquisition and development cost of right at $3 million. Now we're actually purchasing it a little less than that, but we're going to value add by doing some construction, some tenant build out, and some other things. We got a little bit of site development, fire line underground for $40,000 because it's not sprinklered right now. Some upfit costs that we have projected here of $160,000. We've got some upfit costs, as you'll see here, of somewhere around $161,000. But all in total, $3 million. But all in, we determined that we've got a total development cost of $3 million. Now, if I go back to my project summary, well, actually, let's pop down to the building income and let me show you that right quick. And it's got some pretty cool tools for determining stabilization or the velocity of lease up. But you'll see here we've got roughly 11,000 square foot of building, $27 a square foot, including common area maintenance, which gives us a total revenue of $275,000 when it's fully stabilized. So if I go back to my project center, so in this particular case, we're going to place some debt on it. We're raising right at, we're contributing right at $1 million of debt, or about 30% debt to equity or loan to cost. We're even figuring a pretty robust interest rate of 8%, and which would, shoot. By the way, I don't want to show Mansfield. If it ever shows, we need to blank it out. Okay.
Do you want to do that again from the project summary page, because it's going to look different whenever I edit it?
Okay. If I can remember. So going back to our project center, remember that we've got about $3 million worth of total development cost. We're going to borrow about 30%. We're going to borrow about 70%, which brings our total principal borrowed to right at $2 million. I'm going to figure 8% my interest rate. I've got some miscellaneous closing fees, yada, yada, yada. So our projected mortgage balance is right at $2 million. Now this is for construction and for now this is for construction and our long-term. Now this is for construction. Now this particular system is determining also our construction loan and our interest carry, which carries over into our full mortgage amount when we're ready to go from construction to permanent financing. I say all that to say, as you come down to the financial performance summary, it already calculates what my annual debt service is here. So going in, remember I've got $27 a square foot, a total of $275,000 in total effective operating income. We've calculated about 3% operating expense escalation here, but fully stabilized. This will have a net operating income of right at $275,000. Now that's going to be important in just a second. So all in all, our debt service coverage ratio, or the amount of so all in all our debt service coverage ratio is right at, fully stabilized, our debt service coverage ratio is 1.34 in these 2 years that we're doing our financial modeling on. So remember, we've got a net operating income of $275,000. To determine your effective going out internal rate of return, it's always based on your net operating income, net of any debt. So in this particular system, we have the opportunity to play with internal rate of returns. So for this particular calculation, I'm going to use a cap rate of 7%, which gives me a projected sales price in year 3 of 3.9, close to $4 million. Now remember, I went in at a development cost of right at, now remember I went in, now remember I went in with the total development cost.
Sorry.
I actually want to do this. Now remember I went in with a total development cost of right at $3 million. That was everything all in that you see on this right-hand column. Soft costs, architectural cost, tenant finish cost, construction cost, site development cost. I'm at $3 million. But notice now, based upon my net operating income of $275,000 in years 2 and 3 at stabilization, the project really has a market value and hopefully an appraisal value of close to $4 million. So remember the disparity between those two. That's close to $1 million that we have value added, fully stabilized.
That was good.
Okay? Okay, so remember our new valuation based upon a 7% cap, let me enlarge it just a little bit, is $3.9 million based upon the net operating income. We're going to place new debt on it in the form of a cash out refinance at 70% loan to value, which makes our new mortgage at $2.7 million. Our original mortgage was $2.038 million, or around $2 million, which yields a cash out refinance value or tax-free money that comes back to you as investors of $692,000. So remember from the project summary, our original investment was right at $1 million. We've just got $692,000 back as a tax-free, and now it's debt, so debt is not taxed, but we get this $692,000 back as a cash out refi. Now you take that minus your $1,020,000 that you originally put in it, which leaves you only $328,000 of embedded equity. So I want to know what my original return is now that I've still kept the property. So I take the $692,000 back into my original $1,020,000 investment. So far, within the course of this term that we're figuring this, if you divide this into this, you get a whopping 67% return back, tax-free to your investors initially, and you still own the property. That is the greatest element of wealth building for cash out refinanced. So now that we've gone over this initial high-level return, I'm going to show you the 4 specific advantages that I've come up with for a cash out refinance. So here are the 4 major advantages of a cash out refinance. Number 1, the proceeds are tax-free because all the proceeds are debt, and debt is not taxed. Number 2, you get to retain the project. And usually it's under the same ownership structure. Number 3, you get to continue to receive all the existing depreciation advantages. And number 4, you get to leverage your proceeds to increase your real estate empire. Now, to keep you really conservative investors from falling off a cliff from placing more debt on an existing property, let me give you 4 specific rules. I call them Barron's core rules for cash out refinancing, and I stick to these rules when I'm doing a cash out refi. Number 1, and this is important, my debt service coverage ratio has to be 1.3 or greater. And this usually goes without saying because most banks are not going to lend, especially in this environment, unless it's stabilized to that point and your debt service coverage ratio is equal to that or greater. So they pretty well keep us in check. So that's number 1. Number 2, I want my break even on any cash out refinance to be 75% or less. Number 3, I want to have another project identified where I can use the proceeds of the cash out refi ready to go. And that project needs to be within my particular constraints and within my particular risk tolerance, and I call that within my buy box. So this takes some forensics right here. I mean, you've got to line these things up. Remember, I'm building a business as well, so I want to have a project identified that fits my particular parameters, cash on cash, internal rate of return going out, demographics, all those things that I explained last week. And number 4, I want to have at least 40% equity. Sorry, I don't write very well when I've been on the plane forever. I want to have at least 40% equity in the original project before I do a cash out refi. So for me, again, I've set up these franchise rules to build my business by. So when I do a cash out refi, I want debt service coverage ratio at 1.3 or greater, break even at 75% or less. I need to have a project identified that's in my buy box, and I want 40% embedded equity in the original project. So again, in summary, the Barron rules for cash out refinance, or core as I like to call them, debt service coverage ratio 1.3 or greater, break even at 75% or less, a project identified in my buy box, and 40% embedded equity. Thanks everybody for joining us again today. I hope this information was valuable. I know if you use it, you'll build your real estate empire too. And remember, educate, always evaluate so that you can ultimately execute to grow your own personal wealth. See you next week. And remember, if you're enjoying the content, be sure and hit the like and subscribe button for us.